Welcome to this reading on applied benchmarking. So what we're doing in this relatively small reading is we're going to be applying benchmarking techniques to different types of alternative assets. So in other words, we're looking at the common benchmarking approaches for different types of alts, commodities, CTAs, which, commodity trading advisors, that's what that stands for, who are managed futures funds, private equity managers. We'll look at asset-based versus peer groups. Under asset-based benchmarks, we have the public market equivalent tools, PME, public market equivalent tools. These are measuring what returns we would have got hypothetically if we had invested in the public market index. We're hoping, of course, that private equity has outperformed that. We'll also look at some techniques for benchmarking real estate. So first up, commodity indices. Commodity indices are indices published by data providers. They actually are made up of a basket of commodity futures contracts. Now, these can either be value-based or quantity-based. Now, be careful with these definitions. I always think quantity-based is the one that gives itself away a bit better. Quantity-based means that there is a fixed quantity of the commodity in the index, all right? Now, you might sort of say, well, how do you do that with a futures contract? Well, of course, a futures contract will specify a size, a notional principal. So, one contract might be for 1,000 barrels of oil, for example, 1,000 barrels of crude, and the index provider specifies there's 100 contracts in the index. Okay, so 100 times the 100,000 barrels of the commodity are in the index, essentially. So with that fixed quantity, as long as you hold the right number of contracts, you don't need to rebalance, all right? No rebalancing. So that tells us that the value-based, so-called value-based index actually has a target weight. That's what they mean. They have a target weight in the index, okay? So value-based indices, it's no surprise. The slide is saying there are fixed weights here for futures contracts in terms of proportion of the index, all right? So there would be rebalancing here. In other words, if you just had crude and gold, 60-40, if crude outperformed gold, you'd find that you'd have to rebalance. You'd have to sell back down. If you're tracking this index, you'd sell back down your crude. Maybe it's gone up to 65% and gold's gone down to 35. You'd sell down your crude from 65 to 60, buy up your gold from 35 to 40. It's the quantity-based index that doesn't require balancing because you have a fixed number of contracts, doesn't need to be rebalanced, and so we allow the weights to vary. So, for example, at 1,000 crude contracts, 200 gold contracts, we fix the quantity and let the weights vary. And that's how, this is the confusion in my mind. I find these quite difficult to navigate these. The confusion comes from the fact that most equity indices are actually quantity-based. They identify the number of shares that are outstanding, and then, of course, if they base their indices on that number of shares, they might free float adjust, not getting dragged into that discussion. But of course, that means that the indices themselves are actually market value weighted. In other words, you don't rebalance them. They're just, you've got a fixed number of shares that are outstanding, and you allow the weights in the index to change according to what the shares are worth, what the market caps are worth. So quantity-based is what we're used to. This value-based approach is actually fixing weights in the index. It's fixing a value that we want in the index relative to other values, okay? Now, when it comes to the different types of index you can look at, regardless of their weighting system, which we're looking at here, any weighting system can have different types of indices in terms of what returns we're calculating. So we can have total return indices. These track all sources of return from a fully collateralized portfolio of commodity futures. So what does that mean, fully collateralized? Well, a fully collateralized portfolio has a futures contract in it, but it also has a bag of cash, which is collateralizing the futures. Now, the bag of cash is really pre-funding losses under the futures contract. That's what it is.